In this video, I'm going to go over the Trump proposed tax plan and the Harris proposed tax plan on a summary basis. And what you can also do is check out these videos right here where I talk about the individual Trump and Harris tax plan proposal. With the election just weeks away, we have a lot to talk about when it comes to both Harris and Trump's tax plan proposals. They're extremely different from the position of more aggressive tax hikes versus lowering the tax altogether, but there are some commonalities in both plans. And what I wanted to spend a little time here today is going over both of the proposed tax plans, going over some kind of benefits and detriments here and how it would affect you as a taxpayer. Now, one thing that we have to make sure we understand is what they're saying on the campaign trail is going to affect us if it gets passed, but it still has to go through Congress in order for it to get passed. So what we're talking about today is the proposal and essentially understanding what their agenda is. The other thing that we have to pay attention to is that we have to look at everything that we're discussing from a macroeconomic perspective and not just a microeconomic perspective, because what happens today is going to play a role and actually be realized in future years on a macro level. What do I mean by that? I mean that certain tax cuts, while people are saying, yes, it's going to produce a deficit and add to the trillions of dollars that America currently owns, what people are don't saying and really aren't paying attention to are the potential jobs that all these tax cuts are going to create. And that is really realized on the macro level over a period of years. Let's get into this right now, and let's first look at what the presidential nominee and current Vice President of the United States, President Kamala Harris, has to say. What she wants to do is hike up the taxes for the wealthier individuals in America and essentially lower taxes in ways of certain credits for the lower income taxpayers. One of the biggest and most controversial, I would say, proposals in her plan is taxing unrealized gain, an unrealized phantom tax, with a proposal of the ultra millionaire tax that Elizabeth Warren proposed a little while back. Now, what's unrealized gains? If you have a trading portfolio, and ordinary trading brokerage portfolio, not something that you have in a retirement account, but let's say you have an account in Charles Schwab or Fidelity, you buy a stock for $200 and that stock jumps for $300, but you haven't sold it. You're just holding it in your portfolio. Generally, you wouldn't recognize any taxable income from that kind of transaction because you're still holding it. That gain hasn't been realized. It's generally realized when you sell it. So when you actually sell that stock, then with current rates, you're going to pay a tax on that capital gain ranging anywhere from 0% upwards to 20%. That's really depending on where your tax bracket is and the other gains that you have in your portfolio that year. What Harris is proposing is to actually tax that unrealized gain, meaning the holding gain on the stock that you haven't even sold yet, at a 25% rate. I don't really know how that makes sense. What's essentially going to happen is you having to shell out cash and basically being forced to liquidate some of your portfolio to actually pay that tax. And the other question that we have is, well, how is this tax even assessed? I would assume that they would look at the value of the portfolio at 12/31, end of the year. Otherwise, I can't imagine that they take some arbitrary number to assess the tax on. And then what about unrealized losses? Are you going to be able to benefit from those as well? Because as you know, the market is volatile. That stock can be worth, in our example, let's say $300 at the end of the year, but then a few days later, it can drop back down to $200. And what happens then, right? It's a really slippery slope. I'm curious to see if that even gets through Congress. Another thing that we should look at while we're on the topic of capital gains is the proposed increase to the long-term capital gain tax rate in general. Harris is proposing increasing that tax rate to 28%. Yes, I understand that she's proposing this to individuals that earn $1 million or more in income. However, you have to remember that there's already an assessment of a 3.8 net investment income tax that is assessed on those capital gains. So what I said a few moments ago, where the maximum capital gains rate is 20%, yes, indeed it is, but if you make a certain amount of income, you're already assessed an additional 3.8. So your effective tax rate in that scenario is 23%. 23.8%. If we bring it up to 28%, we add that additional 3.8% of net investment income tax, which, by the way, they also want to increase. That's actually going to push that long-term capital gain tax rate to almost 32%. That is a lot of money. We're already looking at short-term gains being taxed at your effective income tax rate. Having long-term gains taxed at a 28 plus 3.8, which is 32% income tax rate, that's egregious. Also, we have to take into account, we're talking about federal taxes here. The states that individuals live in also play a significant role in the overall income tax that taxpayers are paying. So if you're living in a state like New York, specifically in New York City, where the maximum tax rate is close to 15%, we're talking about 32% plus 15% on a long-term capital gain, which is 47%. We're talking about close to 50% in tax from your capital gain transactions. That's ludicrous. And that's just investment income, passive income. This isn't something that you're earning through a regular job. The next thing that I want to discuss with Harris is Kamala Harris is proposing a $25,000 first-time homebuyer credit. This may sound like a great idea if you're going to get a $25,000 credit. I believe it's over a course of 4 years or so. But what we really have to realize, going to that macro thought process, is if sellers are going to know that buyers are going to get that $25,000 credit, I believe that ultimately that credit is going to be realized in cost of homes in the future. So this may be a net-net effect where the only people that really benefit from this are the sellers. So it may not really benefit us as we think that it will, just like when a lot of dilution happens to the US dollar, as we had with the $600 bonus checks during COVID and increases of minimum wage. It really trickles down, and it hurts the ultimate consumer, the end consumer, at the end of the day. For those of you that have kids, Kamala Harris is proposing an increase to the child tax credit. This is actually something that makes a lot of sense because she's going to stagger the increases in the child tax credit. So the first year, so for newborns, those of you who are having babies in the current year, you will get a $6,000 child tax credit in the first year of life, which I think is extremely generous because being a parent, those of you that are parents as well, you know that you're spending money on diapers, on formula, sometimes you need some childcare to come in. That's an actually extremely generous credit that many parents can definitely benefit from. Now, she's also proposing to increase the child tax care credit, which is currently $2,000 to $3,600, which, again, those parents out there watching know that that's going to be a significant help because raising kids is quite significant. Today, we see that kids are still at home during college and post-college can be quite significant when you're incorporating extracurricular activities for younger kids, childcare for younger kids, food, obviously the shelter, clothing, etc. We're talking about a significant investment in your kids. So that can hopefully help some people out there. Now let's segue into Kamala Harris's 1031 exchange proposal. The 1031 exchange is a real property exchange vehicle where you essentially defer the gain into a property that you're acquiring, or essentially swapping. What that means is you have rental property A, you want to buy rental property B and get rid of rental property A. So what you're going to do is enter a 1031 exchange and sell off rental property A, buy rental property B, and as long as you follow the terms of the exchange and go by all the guidelines and rules, you can take the capital gain from rental property A and defer it into rental property B, not having to pay the gain on selling rental property A. Now, currently there's no limit on what you can defer into the second property, but what Kamala Harris is proposing is to put a $500,000 gain or cap on that exchange. So you can only defer up to $500,000, and anything in excess is going to be taxed as a long-term or short-term capital gain. And if we're looking at her long-term capital gain proposals, that may be taxed at a 28% tax rate. And let's also take another step back. That also may be taxed, just the holding of that rental property may also fall into that unrealized taxable gain proposal as well. So this is a slippery slope. One other thing that I wanted to mention about 1031 exchanges, they've already been diluted over the years. As the current tax law is today, we're only allowed to have 1031 exchanges with real property, meaning real estate. Whereas before, in prior years, we were actually allowed to swap other business assets as well, meaning a truck for a truck, a boat for a boat, a piece of machinery and equipment for another piece of machinery and equipment, and also take advantage of the 1031 exchange. That was actually X'd out several years back, and now it's already limited, and now Harris is proposing to put another limit on this exchange as well. With this trajectory, it's only inevitable that that would just be wiped out altogether if they keep going down this path. Slippery slope. Think about that. When it comes to businesses, Vice President Harris wants to increase the current corporate tax rate from 21% to 28%. Now again, this may sound like the rich are going to pay their fair share, but we really have to go back and really analyze this from a macroeconomic perspective. Whenever taxes are imposed on corporations or the wealthier individuals, what corporations and businesses seem to do is limit their resources that they're investing back into their business. Now, what does that mean? They may figure out ways to cut down their workforce because they may not have that additional spending power to increase the workforce or maintain it to where it is today. And the opposite is true as well. So when we have a cut in corporate taxes, such as what we experienced with the Tax Cuts and Jobs Act, where the tax rate went from 35% to 21%, there was an increase in jobs. And that's generally what happens overall. And the surprising factor is here, not only do jobs in the economy grow, but also tax revenue grows, because more companies are also more incentivized to get more stuff sold, done, produced, etc. Because they know that the tax rate is lower, they can hire more employees, invest more resources into their business, and grow their bottom line. Because the alternative is we can't put the money back into our business, we're gonna put the money back into Uncle Sam's hands. And then Uncle Sam will invest it at his own discretion. And a lot of people feel very differently about how Uncle Sam invests our tax dollars. So let's keep that in mind come election time as well. Now, one underlying theme that both Trump and Harris have is the no tax on tips. Now, this is something that we've been discussing for quite some time now, and what essentially they're planning on doing is not tax any tip income. And this is actually a very interesting industry right now, because right now, tips are really not that regulated. It's very hard to enforce employers to report and track the tips because they're hard to track, especially if the staff is getting cash. And in addition to that, there are procedures in place right now in the tax system that encourage employers to report tip income, and that's purely through tip credits. This is already an area that is underreported in general. So by them eliminating it, I don't know if it's going to play a significant role in the tax loss that the federal government is going to realize. Now, a beneficial part of Harris's tax plan is the increase of startup costs for many businesses out there. Now, the current landscape and the current law allows up to $5,000 of startup costs to be deducted in the year that you start your business. The rest, anything over and above $5,000, is actually amortized over 15 years. Now, what Harris is proposing is to be able to deduct up to $50,000 of startup costs in the year that you start your business. That is a phenomenal idea because it's going to actually allow startup business owners to get some cash back into their hands through ways of deductions, meaning your actual deduction for the current year is going to go up essentially from potentially $5,000 to up to $50,000. And for all those business owners, you guys know that generally the first year in business is extremely cash intensive and one of the hardest years to get through. It's actually a very generous proposal out there, and we'll see if Congress is going to go with that and pass it. In this video, I want to discuss Trump's proposal for the tax plan if he gets to office in 2025. As you all know, Donald Trump is out there campaigning to be the next president of the United States, and part of that campaign, he introduced his tax plan if he gets to office. I wanted to spend a little time breaking that down, going over the highlights, and showing you how it would affect everybody in America. Now, it's obvious to us that he would want to establish some sort of permanence to the Tax Cuts and Jobs Act that he had established when he was in office. Now let's highlight what we're talking about here. He had increased the standard deduction and eliminated the personal exemption, which we're currently looking at about $15,000 per taxpayer. We're looking at the qualified business income deduction, which is a huge savings for small business owners. If you own or operate a pass-through entity, you get to deduct up to 20% of that pass-through income that's flowing through to you. Of course, there are some income limitations and industry limitations, but for the small business owners out there, it's a huge help. Let's paint that picture out for you. If you have $100,000 coming in to you from your small business, you can take that $20,000 and deduct it from your income to get to your taxable income. That's a huge deduction. He wants to keep that as a permanent item. Other things that he wants to do is eliminate altogether the state and local income tax deduction and allow for that cap to basically go away so you can deduct state taxes as an itemized component. And of course, bring back one of our personal favorites, the 100% bonus depreciation that we have been enjoying for many years. That, as you may be aware of, is going to be phasing out to zero, meaning bonus depreciation will soon be going away unless something is done about it. Now, keep in mind, everything that we're talking about today is just a proposal, because at the end of the day, the nominees can say anything they want on the campaign trail. We will understand the direction of their tax proposals and what their administration will fight for if they get into office, but we have to remember that at the end of the day, Congress still has to pass all of these laws in order for them to affect us. That said, let's continue on with what Trump had proposed. The other thing that he wants to do is, and we've spoken about this before, is eliminate tax on tips. I've discussed a lot of this in my Harris video, and we can discuss more about it here in a second, but reference that over here if you want to know more about it. Essentially, what we're looking at is the elimination of tax on tips, which is an area that is generally unreported in the industry at baseline, because a lot of these tips are paid with cash. It's hard to enforce because the owner isn't necessarily looking over the shoulder of every single employee when they do receive cash tips. Why do I say this with such confidence? The government even acknowledges this. They effectively give a tax credit to employers that report tips on employees' wages in industries where tips are extremely high and make up a good portion of the employee's revenue. So if taxes on tips go away and they are effectively non-taxable, I'm not sure that it would play a huge role in that deficit that the overall tax cuts for both Harris and Trump are going to yield. On the thought of eliminating taxes altogether, let's talk about this very interesting one. Trump has proposed to eliminate taxes on Social Security income. That's right, eliminate them altogether. Now, one other thing that I want to point out is that many people don't even realize that when you retire, you are subject to income taxation on your Social Security income. This is tiered, and not everybody has to pay tax on Social Security income. It really depends on the overall adjusted gross income and the brackets that you fall into. Meaning if you have other income while you're retired, pensions, other investments that are still coming in, then you may have to pay tax on your Social Security income. And how's that even taxed? Let's talk about that for a second. You may have to pay tax on up to 85% of your income, which is significant when you're retired. Also, keep in mind that you've been paying into the system consistently. You've been paying a tax from your ordinary wage into that Social Security system. So it's kind of taxed on both ends, which is a pill that's a little hard to swallow. So eliminating the tax overall on Social Security income may be a nice gift to the recipients. Current analyses do state that doing this may actually deplete the coffers of the Social Security system by 1 year. They've also been saying this for decades, so I don't know how factual that may actually be. So let's move on to business taxes. As we may remember, Trump had actually decreased the corporate tax rate from 35% to 21% when he was in office. That did encourage domestic production as well as increase, surprisingly, the revenue that the feds had collected. It's funny how things work out that way. Now what Trump wants to do is decrease it even further from 21% to 15%. I want to go and take a step back and look at the macroeconomic effect and not just the microeconomic effect of that policy change. Now, we hear this a lot. Let's tax the rich. The corporations don't pay their fair share. Why is that the case while a smaller individual or a smaller business pays a significantly higher amount in taxes? Let's look at the macroeconomic effect of that statement and what essentially happens in large corporations. Now, if large corporations have to pay whatever they earn into the government's coffers, that leaves less money for them to invest back in their business through R&D, through the construction of new buildings, and through additional employment. So by doing so, owners of these companies have to really sit down and think, well, if we have to give more money to Uncle Sam and essentially allow Uncle Sam to do whatever Uncle Sam wants to do with that money, that does not allow us to grow our business. And by doing that, jobs decrease, GDP decreases, because there are less people employed, less money flows back into the economy. Real estate decreases as well. If my staff cuts down, I have to cut down office space. I mean, I'd have to build that building that I wanted to build next year. There are a lot of macro effects that we have to take into consideration when we're talking about whether we want taxes for corporations to increase or decrease. Something that's commonly overlooked because, again, people look at the immediate. What happens today? You're going to pay less taxes today, or you're going to pay more taxes today, and not really thinking about what the long-term effects are going to be of that. Now, one interesting fact, when taxes are cut significantly, counterintuitively, tax collections actually increased significantly as well. When Reagan cut the taxes from about 96% to significantly less, around 40%, we actually saw a significant increase in tax collections, because while tax changes are going to affect business owners and individuals in year one, by year two, the sophisticated tax attorneys, CPAs, enrolled agents, and other tax professionals are guaranteed to come up with methods to allow those wealthy individuals, corporations, etc., and taxpayers to avoid paying those high income taxes. So there's always going to be a way around it, and you just have to decide which side of the equation you want to be on when you're proposing tax changes. The other thing that Trump is proposing is to increase the child tax credit from $2,000 to $5,000. Now, while Kamala Harris is proposing a tiered structure, meaning newborns at $6,000 and older children at $3,600, Trump is proposing a flat $5,000 child tax credit across the board, which, if you do the math, is actually more beneficial to individuals overall, because that child tax credit stays with you until the kid turns age 13. And that's a lot of money for each individual child that you have in the household. This is the bulk of what Trump is proposing on his campaign trail, but let's keep in mind that all of this still has to be passed and go through Congress in order to be enacted into law. So while right now they're just speaking about it, we'll see what really gets passed come next year. Now, if you like this video, hit that like button, share this with your friends, and I'd love to be able to address any questions that you may have. So go ahead and comment below. I'd love to address the questions that are on your mind. Thanks for watching.